Hi. So now we are dealing with the most interesting topic of CFA, that is Introduction to Asset-Backed Securities, where you'll be understanding the entire securitization value chain. At the end of the topic, I have also added a few clips, basically from which you can also find from YouTube, of this movie called The Big Short, which does a very well explanation by celebrities of what is a CDO or what is a securitization value chain, what is tranching, and all those interesting things are there in the movie. So I would recommend you to watch that movie if you have time, and if you don't have the time to watch the entire movie, which is a very superb movie, by the way, you can also watch the clips that I've added. So in between, I'm going to instruct in the class that this is the clip that you'll have to watch. I'll also show you the glimpse of it, so you all can do that. So let's start with the process of securitization. Okay, welcome everyone. Now I'm actually going to start with my favorite topic of CFA. I think you all must have heard my favorite topic in other topics also, but this is certainly my best topic in CFA because it's a very interesting thing that we probably have not seen in real life. It does happen at the very top-notch level, and that is the business of securitization. So what exactly securitization is and what is this asset-backed securities? So securitization is a process and where the securities are sold, and these securities are called securitized assets. So securitized assets are sold in a market, which is securitization. I know I'm repeating this word securitization a lot, but you're going to hear probably that word from me more hundreds of or thousands of times. Now, there's a lot of theory which is involved around this, but I prefer to do it in a more practical way where I will show you a diagram, a chart of what is this structure of securitization. Now, you all have to bear me that there are many things that you would be encountering for the first time, and you may have various doubts. So I'll explain all of them in the theory that I've written, but I'll reconnect everything back with the diagram. So I'm not saying that just by the diagram you'll understand the business. Well, we'll have to do it simultaneously. I'll have to create a diagram to tell you what is the flow of this business and then connect you with all the dots. So it's a process where it will take around 30 to 40 minutes for you all to at least understand what exactly I'm doing. And a lot of your thinking power will be involved. So I would definitely want your contribution to this to understand the business very well. Otherwise, sitting in this lecture and just listening, it will not make sense. Clear? Ready?
Yes.
Okay. So tell me any bank that you think is a very famous bank. Any bank which does the business of, what is the business of banks? Banks collect deposit and they typically give loans.
Give loans.
So just conclude me any bank that you are aware. I'll take very
SBI.
examples. Yeah. What?
SBI.
SBI, State Bank of India. Any global bank? Yeah.
ICICI.
ICICI, again, it's a Indian bank which is global. Any world famous bank? I mean, I'm being very biased.
Or CIBC.
CIBC.
RBC.
RBC, okay. I can take up. Sorry? Which one, Divesh?
RBL.
RBL, yeah, it's still an Indian bank. What about JP Morgan, Barclays, Citibank, Morgan Stanley?
Yes.
So many banks. Let's take a bank with one of the most assets in the world. Let me take Doshi Bank or a Citibank. Let me take Citibank, which is a global bank. Now, Citibank gives loans to various people. So does it have only one type of loan or various types of loan?
Various.
It has various types of loan, right? So let's say it has a pool of assets. It has a pool of assets. Why do I call that as asset? Because for the Citibank, giving loans for a bank, giving out loans is an asset and collecting deposits is a liability. Am I correct?
Yes.
So banks have a pool of assets. Now, can you tell me what type of loans do banks give generally? You all can name me
Home
any.
loan. Loan, personal loan.
Okay. So let me now give them the exact name. We are basically calling residential mortgage. The home loan that we say is called a residential mortgage. Are you getting me? Correct. Then you have a commercial property, loan for commercial property, which is called a commercial mortgage. Are you with me on this? I'm just using the actual words rather than the words which we used in our day-to-day life. Then banks also give auto loans, or so-called as a car loans, education loans or student loans. Am I correct? Well, education loan is not that famous in the Middle East because fortunate in the Middle East, trust me, the entire education cost is being funded by the governments. That's so amazing. Then what else? Credit card receivables. Banks do have credit card receivables. Am I correct? So these are portfolio of banks' assets. Am I clear? Am I clear? Anyone wants to add something to this?
Business loan.
So business loan basically comes as a working capital loans or capex loan. Yes. So I will take all the business loans, basically commercial loans, but business loans, which can be for working capital or buying a fixed asset, consumer finance, and various other types of loans. Clear? Now, hypothetically assume that Citibank has a portfolio of this loan of, let's say, around, I will give it a random number. Let's say it's a portfolio of $100 million. So Citibank has lended around $100 million. And let's say the average rate of all of this is around, let's say 6%. So what is the process? Over the future years, Citibank will be getting the money by these guys from the pool of assets in the form of interest and principal repayment. Am I correct?
Yes.
And the overall yield that Citibank is going to make is 6%. But Citibank will have to wait for all these loans to mature to realize its $100 million, isn't it?
Yes.
If the Citibank wants to issue more $100 million loan, will it get from these people immediately? No. It will have to raise from the market. It will have to again raise capital from the market of $100 million to create more portfolio. Correct? That's a traditional way. The modern way is securitization. The modern way is securitization. What happens in a securitization? Citibank creates a company whose job is to sell this loan portfolio of $100 million that we have to investors, to the investors. Are you getting my point? What did I say? Citibank is going to create a company specially for the purpose of taking this loan and selling it off to someone. What will happen with that? Citibank will be able to release its $100 million immediately, and someone else will be dependent on the loan repayment, amounts, right? So Citibank is unlocking its capital. It doesn't have to wait for the next 5 to 20 years for these guys to pay back the loan. Am I getting it? I mean, are you all getting it?
Yes.
So Citibank will do what? Citibank will create a special purpose entity, an SPV, or so-called as special purpose enterprise, or special purpose vehicle. Now, what is the objective of this vehicle? Well, we will get into detail of this, but this special purpose entity will collect or buy the Citibank's pool of assets, and then it will pass it on to investors. Are you getting my point? Clear? Now, either it can sell directly or it can sell through the help of some investment bankers. Now, what is this SPV? We are going to discuss in detail about this SPV, but just for your reference, assume that this is just a paper company and one of the subsidiaries created by Citibank. So what did Citibank do? In its balance sheet, they had $100 million of assets, correct? They transferred these assets to the SPV. So who is responsible now for these assets? Is Citibank responsible or SPV?
SPV.
The SPV is responsible. So from the Citibank's book, $100 million of assets are gone out, and Citibank must have collected $100 million from the SPV. Is that clear? Everyone? Citibank collected $100 million of amount from the SPV, and Citibank got this capital, which it can now use to create more loans. Is that clear, everyone?
Yes.
Now, Citibank is going to give this asset to the SPV, the special purpose entity, or so-called as the special purpose vehicle. And this entity will probably, it can have investment bankers or bond traders or merchant bankers who will do what? Let's say they will have investment bankers hired. These investment bankers will do an interesting task. They will, what do they now have? They now have a portfolio of loans, and they do something interesting with that. They will actually do multiple things here. First, they will separate these thousands of loans that people have taken into various classes, into various categories or classes. Everyone, what can be those categories or classes? Listen to me now carefully. So all these bonds, they have a portfolio of bonds. Am I correct? These bonds will be separated based on, let's say, maturity. So all the 5-year maturity will be in one box, 3-year will be in one box, 2-year will be in one box, 20-year will be in another box. Clear? They may also be separated in the form of different coupons, different principal repayments, or different credit ratings, and so on. Are you getting my point? So what did I do? I, as an investment banker, I bundled the loan and then I created boxes of it. Correct? These are different categories of boxes. Everyone with me?
Yes.
Clear? But these boxes will not be directly sold. They will be sold before they will be sold. They will be separated in various tranches. Separated in various tranches. I will now discuss what are tranches. But first of all, let me just tell you, tranches are basically, let's say, tranche 1, tranche 2, tranche 3, tranche 4, etc. There can be unlimited. I'm just having one of the things. The tranche 1 will receive the money first. So whenever the borrowers pay, who will receive the money first? The tranche 1. So will the tranche 1 have highest yield or lowest yield? Think and answer.
Lowest.
Lowest yield. Let's say tranche 1, the yield of tranche 1 is around 3%, because they are going to receive the money first.
Yes.
Then after that, tranche 2 will receive, so they will slightly have more yield. These guys will have more, and then so on. The last tranche will receive only after everyone is paid. So they took all this portfolio, the bag of bonds, separated them into various characteristics, and then made them into various classes. So now they will be now sold to the investors. Are you getting my point?
Yes.
These tranches will be now sold to the investors. Everyone, who will be the investors? Who will be the investors who are willing to buy these bonds exclusively? The investors are mostly institutional investors. What are institutional investors? They can be, can you name me few of the investors which can be in this case? Mutual funds who want to buy portfolio of bonds, banks, corporates, insurance and pension funds. Are you getting my point? Correct. Sovereign wealth funds, SWFs like Abu Dhabi Investment Authority, PIF, Chinese authorities or Norwegian pension funds. Even governments may be involved here to buy these bonds. What if they are AAA credit rating? Then everyone would be interested to buy these bonds, right? Everyone? Clear. So basically, these are the investors who will be involved. But, what are they buying? They are buying a portfolio of assets. And who have, by the way, who are the ones who have basically, borrowed? Those people are called obligers. What are they called as? Obligers. Obligers are the one who have borrowed money. Clear? So once now they pay, the money was supposed to go to Citibank. Am I correct?
Yes.
But now instead of Citibank, the money will directly flow to the SPV. Are you getting it? It will directly flow to the SPV because now Citibank is out of the picture. Clear, everyone? This money will directly flow to the SPV, and the person or the institution which will collect this money from the obligors, which means the borrowers, and give it to the SPV, they are called servicers. They are called servicers. Their job is to serve the debt, collect the money and give it to the SPV. Why SPV? Because SPV took over this $100 million portfolio from the Citibank, sold it to the investors, and then the investment bankers may sell it to the investors. Let's say they may sell it to different yields, which can be higher also, but the average yield will be somewhere. Let's say the SPV, when it sells to investment bankers, it may sell this 100 million portfolio, let's say at an average yield of, will it be more than 6 or less than 6? Will it be more than 6 or less than 6? Interesting. SPV is going to receive how much? 6%, correct?
6%.
But SPV will pass it to less than 6%.
Less.
So that they can make some money, right? The spread. Now, if you check and if you tell me, sir, investment bankers are paying more than 6 also, more than 5 also. But we are talking the average rate. They are also paying less, right? So they will ensure that the average rate is not more than what they get at. Clear?
Yes.
From the investor's point of view, think that the investor here is getting investments into a bond, which is not a single bond, but a portfolio of bonds. Isn't it? That's a portfolio of bond, correct? So can I say investors are getting a more diversified portfolio, right? Yes. But still there is a risk involved in the portfolio of assets because I don't know what is that portfolio of asset, right? Because there are thousands of loans in it. Therefore, the investment bankers will do something that they get more reliability on these securities. And what are the things that the investment bankers will do? Watch out carefully. Since these are bonds, the investment bankers will do the credit rating of these bonds. Are you getting my point? Correct. If the rating is not sufficient, if you recollect from the fixed income previous topic, they can provide some guarantees or something which is called credit enhancement. Are you aware about this? We discussed about this. Credit
Yes.
enhancement means over collateralization or giving some additional guarantees, which will give more reliability to the investors. And since it is a public money involved, they will also appoint trustees who will look after the rights and duties and protect the rights of the investors. Is that clear, everyone?
Yes.
Now, the one who has created this structure is called the originator. It's called the originator. The ones who are borrowers are called obligers. Then there is an SPV, which is an important structure. And then there are investors, which are also an important part. Along with that, there are credit rating agencies, there are credit enhancement companies, trustees, investment bankers, and servicer, which are involved. I'll come on all of this one by one. And then there are various people who help you create this structure, which create this structure of what? Create this structure of securitization. It's not an easy job. So the ones who help you create this structure of securitization, who are the ones who will help you create these structures? Sorry. The ones who help you create this structure are team of, you can say, investment bankers, consultants, lawyers, accountants, compliance, and etc. officer, because these are the ones who will help you structure the deal. Are you getting me, everyone? Now, see this deal. This is a typical securitization structure by whatever my handwriting or diagram making skills are. I'll touch upon all of these aspects one by one now, but I hope you have got some idea of basically what is the some idea of the structure, right, everyone? Now I know you may have a lot of questions, but before you all hit those questions, let me go one by one. First, just think from this overall structure. What is the biggest objective that originator, Citibank, is achieving here? What is the biggest objective that Citibank is achieving here? Can you tell me?
Money is not blocked. They get the
Unblocked. Money is
Unblocked.
unlocked, I should say. Money is unlocked. Correct? They release their capital instead of their capital being blocked for a long time.
Yes.
Right? Now, so the biggest objective here is to unlock capital or raise capital and not being dependent on the borrowers to pay and come back. Rather, what we can do perhaps is that we can just securitize it. We can sell this portfolio to the investors and get out of it. And now we get this $100 million through which we can create another portfolio. In this way, the business multiplies. And that's the biggest reason that today banks have grown exponentially in the last 3 or 4 decades. Are you getting me? Because now banks don't have to wait for a borrower to pay a 20-year loan. They will just sell this portfolio to the investors, get money, and recreate more and more and more loans. Are you getting my point?
Yes.
Right. Now, I'll come back to this diagram again and again, but after understanding some theories. So what is securitization? Securitization, in this case, we are going to sell some securities. Which are the securities? Who's going to sell the securities? The investment banker or the SPV is going to sell the securities or bonds to the investors. And what is the underlying in these bonds? Pool of mortgages. It's not one bond. It's not one borrower. It's a pool of various loans. Clear? So securities that are backed or collateralized. Why are we called collateralized? Because here the collateral is the underlying loan, pool of loan. Such loan receivables are referred to generally as asset-backed securities. So what are asset-backed securities? Those securities which you buy like bonds and the underlying is a pool of asset. Those are called ABS, asset-backed securities. Is that clear? Everyone? What can be in the pool? Can you tell me what can be in the pool of these assets?
Mortgages.
Yeah, different types of loans.
Different
They
types.
can be automobile loans, credit card loans, equity, home loan, manufacturing financing loans, student loans, small businesses loan, corporate loans, and different types of bonds, right? That's called ABS. And out of this, if the portfolio includes only of mortgages, then that's called a MBS, mortgage-backed security. So mortgage-backed security is one of the part of ABS where if the underlying asset is a pool of mortgages, then it's a MBS. Is that clear, everyone? Everyone clear within ABS and MBS?
Yes.
ABS is when the pool of assets have various types of loans, but of that, if the pool is concentrated to only mortgages, then it's called a mortgage-backed security. Clear, everyone. And this entire process that you saw of transforming your assets into securities, which can be sold, is called securitization. What is it called as? Securitization. So can you read what is securitization? Yes, please. Anyone? What is
Securitization is a process whereby the underlying asset, which is a pool of various assets, loans, are purchased by an entity.
Entity, which entity? Who purchases that? The SPV.
SPV.
And the SPV will do what? Will it keep it with itself or sell it?
No, sell it.
Sell it by issuing securities. Those securities are called securitized papers or securitized bonds or securities. Okay, go ahead.
Are purchased by an entity which then issues securities which are supported by the cash flows of these underlying pool of assets, loans.
Or loans, correct. So these securities will pay money based on the borrowers paying back. Clear? Assets that are typically used to create the underlying pool that is used to create the bonds are called securitized assets and include all different types of loan: residential, commercial, automobile, student, bank loan, credit card, etc., etc. Is that clear, everyone? What is securitization? It's a process where the assets, which are loans, different types of loans, they are pulled together, they are transferred to the SPV, and the SPV makes securities out of that pool and sells it to the investors. Is that clear? Everyone? Correct? Any doubts till this point? Yes.
Sir, default होने के भी chances होते हैं.
Of course. Bond means there is a chance of default. Every bond. So now, as I said, the reason of the biggest, first of all, let me clear, every bank does this. Every financial institution does this. Point number one. How many of them have defaulted? Let's say there are thousands of financial institutions and banks in the world. The default depends on the underlying asset. How have you given that? We'll come to that part at the last. But let me just tell you, just because few of the banks have misused it and defaulted, should I stop this process itself? No, right? See, derivatives is a tool that people have misused. Does that mean that I should stop derivatives trading? No. Absolutely not. Securitization is the most creative concept in the banking, which has helped banks grow exponentially. But some of them have, in the wake of growing exponentially, created a disaster situation due to which we went into the 2007-8 subprime crisis. So when I said that the tremendous growth of the global banking, not only US banking, is due to securitization, the disaster of that is also because of securitization. But I am always a believer that don't, blame the Process, because the people are bad. The process is interesting, the product is interesting, but we can't blame the product or the process because some people misused it. There are perils of online transaction. Does there, like, have we not heard about cases of cyber crimes where people's money from banks have been siphoned off by cyber, criminals, the hackers and all, isn't it?
Yes.
Has that happened or not?
Yes.
Does that mean that we should stop all the online transactions?
No.
Of course not. So, of course, there has to be some protection, some regulation. That's all there. We will discuss about that also. But yes, there is anywhere where there is a bond involved, there is a default risk. Now, how have you given out those loans becomes an interesting, and I'll come to that point at the last. First of all, I don't want to start with, what disaster it created. I wanted to hide that because I wanted you all to first respect the process, understand the process, rather than just focusing on what mess it happened. We'll come up to the mess also. Clear? But yes, it's a very interesting process to immediately unlock your capital. Clear? Everyone?
Yes.
So who are the participants here? Participants, the one who started the process. Who was the one who started the process? The originator, which is the bank or a financial institution. Then you have obligers who borrowed the money. Then you had a company which was specially formed for this purpose called SPV. Then you had the servicers who collected the money from the pool and transferred it to the SPV. Then you had investment bankers, consultants, lawyers, underwriters who will help you structure the deal. And then there are credit rating agencies, credit enhancement companies, trustees who are here to help you provide security and safety. And finally, then there are investors who are the ones who want to put their money in the securitized bonds. Correct? Let's see them one by one. Originators, the company which wants capital, right? Which wants to raise funds, the bank. Obligers are the ones who have borrowed money from the originator. Clear? SPE or SPV is a legally independent company set up specially by the originator especially for the purpose of securitization. Now it is also called as a bankruptcy remote entity. Why? Because if there is any problem with the originator, let's say tomorrow, if Citibank becomes bankrupt, then the borrowers will claim on the asset of Citibank. Yes or no?
Yes.
But these assets are now being transferred to the SPV, so the borrowers cannot claim anything from these $100 million of assets. Are you getting my point? Because SPV on the paper is a different entity. Clear? So. Is there a chance if the Citibank does default, does it mean that the SPV also defaults? No. SPV is not going to default because Citibank defaults, because Citibank may have several of loans of this one portfolio Citibank has given to the SPV. So there's no correlation that Citibank defaults and the SPV also defaults. Both have now different classes of assets. Clear, everyone? Therefore, SPVs are also called as bankruptcy remote vehicles. Clear, everyone? What was the role of servicer? They help in collection and transfer of amount from the obligors to the investors. Am I correct, everyone? Everyone? Let me know if there's any problem.
Yes.
Please interrupt. Then there are others who help you support, like the rating agencies, the credit enhancement providers. Rating agencies, because you're buying bond, you need to provide ratings of these securities. If there is more reliability required, more assurance required, then you need to give more support in the form of credit guarantees, which the originator will have to bring in. And then there are investment bankers who are going to help in structuring the deal, pitching the securities to the investors, and creating a market for your securitized papers. Finally, there are investors who are corporates, mutual funds, pension funds, sovereign wealth funds, banks, insurance, governments, everyone who are willing to invest their money for a while. And then there are various other types of people like independent accountants, lawyers, attorneys, trustees, underwriters, and so many people involved in execution of the deal. this is the business of securitization. So can you just imagine the employment that securitization generates? Clear, everyone? Correct.
Yes.
Did you understand the role of every participant here? Every organ, every structure that is involved? Correct. If you understood that, then now let me go to the three biggest beneficiaries of this structure. First, who gets the biggest benefit?
Citibank.
The borrower.
Oh,
The
borrower.
Citibank, basically borrower means Citibank needs money, right?
Yes.
Second, the investors, they get opportunity to put the money. And this creates a big market between borrowers and lenders. So the market overall also benefits. So the major objective of securitization is to generate a source of capital and liquidity at low cost. However, the range of benefits, there are various other benefits that we are going to see. The first, the investors. What do investors get? Instead of putting their money in one bond, they now get a portfolio of bonds by the borrowers. So they get variety of securities which they can select. How come? You remember I had transferred these securities into various tranches and various categories like maturities, coupon and all. Correct. So it's like you have brought this different types of vegetables at your home and you've created various recipes of that into various different tastes. And now you tell the people whichever recipe you want to buy, you can buy. Are you getting my point? So someone like me who wants to buy a AA rated bond, I will select a AA rated bond. And in that, I may select tranche 4 because I want to take risk and I want more returns. Clear? Everyone?
Yes.
So I have a variety of choices. We'll come back to these choices in a while. We'll come back and detailed discussion of the tranches. But I have variety of securities which I can choose as per my need. And therefore, I don't invest in one bond. I invest in a portfolio of bonds. So I get a diversification benefit. My risk can be reduced. Clear? Compared to a direct investments. On the other end, the borrowers, they now get a direct deal. They don't have the banks to be a mediator. Now, actually, you know what? In the securitization, who are the two people involved directly in the deal? The bank is going out of the picture, correct? So it is the obligers, that is the borrowers and the investors who are involved, right? Tell me one thing. Why do you deposit money in the bank? Why do you deposit money in the bank? Come on.
To get interest.
Earn some income, right?
Yes.
Now, do you have any control on who the banks give loan to?
No.
Of course not. Right? Of course, the government secures the bank, so you have very much, you may not lose, but we have also seen situation where people have lost all their savings with the banks. Correct? Because ultimately the banks are going to give this money to investors to borrow for their projects, right? So what if now the banks go out of the picture, so the market is directly between the demand and the supply, the borrowers and the lenders. Are you getting my point? So investors are indirectly or directly getting access to, they're directly funding the borrowers and the borrowers are getting directly funded by the investors. So this actually creates a big, bridge between the ultimate borrowers and the ultimate lenders. So lowering of cost by borrowers and enhancing risk-adjusted return to ultimate investors, improvement of banks' profitability. Do you see your bank's profitability has increased? How? Can someone explain me? Banks had created the portfolio of loan at, in my example here. No. Banks had, everything is right in front of your eyes. Banks had created a portfolio of $100 million at 6%, but then they sold it to the investors at 5%. Have they made profit or loss? Of course,
Profit.
They have made profit. So this is also another way through banks have not only unlocked their capital, but they can increase their profitability. Clear? Right? Overall, the market benefits because now there are more securities out in the open for trading, right? Instead of original loan book, now the original loan book has become liquid. So people can buy and sell the securities. So the liquidity factor has added, and the overall financial markets greatly benefit with this liquidity. And this innovation has increased the investments fourfold in the overall financial markets. The banks are able to generate more and more money and create more and more capital for the overall market. Everyone cleared with securitization, participants, benefits and all?
Yes.
Now, one thing that I displayed, that the investment banks don't sell directly the securities. They create some structural changes into it, which is what we call as tranching. Tranching. Tranching is a simple transaction which may involve selling off of one of the bond classes, but there is a redistribution of prepayment risk. What is a prepayment risk? What is a prepayment risk? Normally in a loan, every year you pay, assuming it's an amortizing loan, you pay interest and principal. Correct.
Yes.
So if it's a 20-year loan, over the next 20 years, you're going to pay the interest and principal. But if I get enough money now, why should I not prepay my loan and reduce my installment or reduce my interests or reduce my maturity, right? So when people pay before time, it's good for the borrowers, but not for the investors, because investors face the prepayment risk, reinvestment risk. Are you aware about this?
Yes.
So from the investments point of view, prepayment is a risk. If the borrowers pay earlier, then it's more like a callable bond. I'll have to reinvest for the remaining maturity. Now, in order to avoid this, or in order to diversify this, we create tranches as to who gets first, who gets last. So these tranches can be based on time or can be based on credit. Time tranches are also called as waterfall structures. So under the waterfalls from the top. So whatever money is being received from the pool, it first will go to tranche 1, 2, 3, 4, and then on. Are you getting my point? So everyone is paid in a sequence. That is called waterfall structure. Clear, everyone? Credit tranching, on the other end, is where the losses, if any, will be distributed based on some criteria. So here the bonds are classified and distributed based on how they will share any losses resulting from the defaults. So we create a structure called senior bonds or subordinate bonds and junior bonds. So the credit risk is spread between various categories of bondholders. So two things are, created in boxes. The cash flows, who will get paid first and later on, and the credit risk, who will bear the loss first and who will bear the loss last. These are called time tranching and credit tranching. Is that clear, everyone? Will this reduce my risk? No, it will spread out my risk between investors. Now, investors are aware as to which tranche they are buying, how much is the risk in it, and accordingly they get the returns. Is that clear? Yes or no, everyone?
Yes.
Any questions on this? The most important thing here is the structure, the creation of a structure of SPV or SPE, special purpose vehicle. It enables the companies to raise funds via securitization. So for the process of securitization and getting funds from the investors, we create an SPV. Ironically, the credit rating of the SPV is very different from the credit rating of Citibank, because Citibank may have various other obligations which SPV may not have. So actually, the credit rating of the SPV at times is better because it's a lean company than the originator. So guys, if the credit rating is better, I can issue the bonds at lower rate, or I will issue the bonds at higher yield.
Lower it.
Lower yield. That's why I will issue the bond to the investment banker at 5%. I can do that because my credit rating is better. Clear?
Yes.
So the overall funding cost will be reduced as compared to the corporate bond issued by the originator. And we also know that SPV is a bankruptcy remote vehicle. So any securities that the SPV has are free from the clutches or the credit claims in case if they would have been with the originator. Is that clear, everyone? So help raise funds, improve credit rating, right? Reduce the funding cost due to this, and being bankruptcy safe. That is what the major role or objective of SPV creation is. Is that clear?
Yes.
However, there is a twist here. We have actually separated the credit risk into different boxes. Now assume that the company defaults. Who gets paid first? Who gets paid first in the liquidation process? Come on, it's so easy. Now we've done it again and again.
Debt holders.
The bondholders, then the preferred, and then the equity. Within the bondholders also, you will pay the senior, then the subordinate, and so on, right? So it has to follow a flow. Only if the tops are paid and if something is remaining, then it goes to the next one, right?
Yes.
That is called the priority of claim. In liquidations, absolute priority generally holds, which means that the money will go as per the terms and conditions. However, they are saying in real life, when the company is refinanced or reorganized, then the absolute priority claim rule is not held, because the other bondholders who are not going to receive the money or the equity shareholders will drag the company to the court. And the court will say that, you have to give some money to the investors otherwise. So basically, the court will either give verdict in the favor of the other investors or drag the court case, which will ensure that no one gets money. So when a company is reorganized, the strict absolute priority has not always been upheld by the courts. For this reason, the credit spread of a bond backed by collateral does not decrease dramatically. Why? Because even if there is a collateral, there is no guarantee you will get the entire money. Are you getting my point? Clear?
Yes.
Therefore, in the case of securitization, the courts have no discretion to change the seniority, because the bankruptcy of the company does not affect the SPV. The SPV is now a different entity. So whatever happens to the bankrupt originator has got nothing to do with the SPV, because under the law, they both are the different companies. Clear, everyone? So SPV is, you can actually say SPV is like a loophole or like a window given for you to basically secure and unlock your capital, secure your assets and unlock your capital and reduce your cost. Clear? So it's a very good window for us to basically, generate more capital and be safer from the claims of the creditors also. Is that clear, everyone? Everyone? Questions, anyone?
But the SPV also defaults, right?
See what SPV has. SPV has a pool of asset, which is now being sold to the investors. Clear?
Yes.
So actually, I took this calculator from the dealer. I sell it to you. So I have no inventory. Whatever I got, I passed it on to you. Now, when the obligers will pay the interest and principal, my job is to just pass that to you. So I have nothing to lose. Clear?
Yes.
That's where the investors are worried, isn't it? Hence, I will also ensure that I do the credit rating, credit enhancement, create a trustee. I will try to make it as comfortable to you as possible. But now there's nothing for me to default, because I have equal amount of asset and liability, and I'm more like a trader. I just took it and I passed it to you. You as an investor are the owner of the pool now, not me. Clear? Right?
Yes.
Now, why did Citibank create an SPV? Why did Citibank not do it itself? That's a question that I had in the past. Well, what is Citibank's core job? To identify borrowers and give them credit, right?
Credit, yes.
Citibank does not want to get involved in the job of creating the securities and pools and sell it and find out investors and all. So for that, they created a separate structure who are specialized in doing this business. Clear? So Citibank wants to keep its core business separate, and the securitization, it wants to give it to someone else. Is that clear? Got it?
But does all bank do it, or there are some banks which also
See, this
does
is
the securitization?
that all the banks do it, because this is the way through which they get their capital very easily.
Mhm.
What is the other way? The other way is to go to the market and raise funds,
Yes.
which banks will find it difficult. Second, ask the depositors to give me money, which is also difficult. I cannot do an advertisement saying the depositors, please invest with me, please invest with me. Getting it? Correct?
Yes.
So now we will discuss what are the different types of securitizations that we are going to follow. And we will discuss about that. But before that, I just want to show you that what are the different types of asset-backed securities that we are going to deal with. We are going to deal with mortgage-backed securities and non-mortgage-backed securities. Within the mortgage, from the syllabus, we are going to deal residential and commercial. And then in the non-mortgage, there are various types of bonds. There are various types of loans, but we are going to deal with auto loan and credit card loans. These are the two things that we are going to deal with. Correct? Everyone? But our major focus will be on residential mortgage loans. Is that clear, everyone? So now, before we go and understand what is a residential mortgage-backed security, what is a mortgage-backed security? Where the underlying is a mortgage, a home loan or a loan, basically, right? Loan against property. Loan against property is called a mortgage. This mortgage can be residential and commercial. Clear? But are the features of a residential loan and a commercial real estate loan both same? They both have a lot of differences. Let's see that. So first, understand what is a residential mortgage loan. Basically, it's a home loan. Correct? So what is the difference in this compared to other assets? Here, you are going to give the collateral, and your collateral will be your what is going to be the collateral when you take the loan from the bank?
The property.
The real estate property. Correct. Now here, the mortgage, in this mortgage, basically the lender, the bank, has the right to take back the possession of your property in case if you do not pay the loan amount. Correct?
Yes.
So they have the right to take the possession. That's why it's called a mortgage, right? So you have kept your collateral, and against that you've taken the loan. So you have to repay the loan. The higher the LTV ratio, what is LTV? Loan to value ratio. So more and more loan is given against the value, the more riskier it is to the bank. Why? Because the borrower's liability or the borrower's equity is low. Correct? So therefore, there is greater risk for the lender when the LTV ratio is higher or lower?
Higher.
LTV ratio is higher. Correct? If you do not pay the money on time, the bank or the institution has the right to foreclose the loan, to shut down the loan. This is the first thing. Now, let's understand the maturity. In US, typically the home loan is, or the mortgage is between 15 to 30 years. In Europe, it is slightly higher, 20 to 40 years. And in some cases like Japan, it can also go to 50 to 100 years. Why? Because in Japan, we all know that people do live 100 years very easily. Isn't it? Okay. So this is about maturity. Interest rates. Well, how can a home loan be? Basically, most of the home loans are fixed or floating rates.
Fixed.
Most of the home loan, ironically, in the world are floating rate, which is called a variable rate. So there are four basic ways. Now this rate, which is decided on the loan, is called as the mortgage rate or a contract rate, right? It can be fixed, which does not change, which is generally the case with US, France, and Germany. Adjustable or variable rate is the case with most of the world, where the reference rate, for example, even if when you borrow from India, Your loan is based on some benchmark rate, and the interest rates or the installments keep on slightly changing. That's the case with mostly UK, Australia, and South Korea, right? Hybrid mortgage and convertible are very much similar, but slight difference. Hybrid mortgage are fixed till the initial period, and then at some point of time, they can be adjusted to a variable rate. This is also possible in countries like Canada, Denmark, or Switzerland. So initially, when you take the loan, that is fixed, but later on, there is an option where the loan will be readjusted to the benchmark. Now, that is done by the bank itself at some point of time. But in a convertible loan, the borrower has the choice to convert the mortgage from one structure to another structure at some point of time in the future. This is the case in Japan mostly. So in a hybrid mortgage, the banks will decide after a point of time at what revised rate it should be adjusted. Clear? Which can be a fixed rate or a higher fixed rate or lower fixed rate, or can be a floating rate also. But in a convertible, the borrower has a choice. Are you getting my point? What choice the borrower has? To convert the mortgage rate at some point of time in the future, maybe at a fixed or a floating rate. Clear? Everyone? Any questions, anyone? With the interest rate determination, come on. Tell me.
In convertible, so the time is also decided by the borrower.
Not necessarily. It's not completely open. There will be some structure involved. It depends on a case-to-case basis. Honestly, no two loans are similar, by the way. If you go to the bank to borrow, I go to the bank, the rates will be different, the structure will be different, the amount of loan will be, everything will be different. It depends on my credit score as well as the feature of the property. So it can be, it cannot be. That depends on how the banks are offering. Okay. But here the borrower at least has choice to decide the rate, basically. Okay.
Yes.
Now, what you are saying is about interest rates, but there's also the discussion about the principal repayment, how the principal repayment will work. Most of the residential mortgages are amortizing, basically, which means there will be a combination of interest and principal both to be paid, installments, right?
Yes.
Now, within the amortizing, there are two categories: interest only amortizing and interest only lifetime mortgage. Interest only mortgage is that where the borrower pays only interest and does not have to make principal during the initial years. So these were very common initially in US, and then it also came in countries like India, where let's say today you are studying. So you are going to start earning after 2 years. Okay. So for the first 2 years, you just pay me interest, don't pay me the principal. And then for the remaining 8 years, assuming it's a 10-year loan, after that you start paying the principal. Are you getting my point?
For study, educational loan, yeah, it is.
Yeah, so that's called interest only mortgage. But interest only lifetime mortgage, here there is no principal payment required till the entire life of the loan, and there is one big payment, the balloon payment is given directly at the end, which is like a bullet mortgage. So the original amount is repaid at the end. So then it's not an amortizing loan, basically, right? Because the principal repayment happens once at the last. Rarely there are such loans, but most of the loans are completely amortizing, where from day one itself, the interest and principal component are paid together. Clear? Everyone?
Yes.
But under the housing loan, there is also an option of prepayment. Prepayment basically means that any payment towards a repayment of principal that is excess of the scheduled principal payment. So whatever you were supposed to pay as interest and principal, let's say you were supposed to pay $100 as principal back as per the amortizing schedule. But if you pay more than that, then it's called a prepayment, right? It is an option of early repayment which entitles a borrower to prepay all or part of the outstanding mortgage prior to the schedule. Correct? This is definitely a risk to whom? To the lender. Everyone, right? Why?
Yes.
Because as the interest rates go down, the lender will take the advantage, the borrower will take the advantage of it, and the lender will face the prepayment risk. Therefore, the lenders at times try to discourage this by imposing prepayment penalties. Is that clear? Right? Everyone? Clear?
Yes.
Now, there are two types of loans. One is a recourse and a non-recourse loan. Now, think from the lender's point of view. The lender has given you loan. The lender is worried, what if you don't pay them back? Right? So, lender has taken some collateral from you, correct? Let's say the value of that collateral is $80 and the loan amount is $100. So, even if the lender sells your collateral, the lender will still be at a deficit of $20.
Yes.
That shortfall, the lender can recover from your other assets or your personal assets, correct? That is called a recourse loan. So in a recourse loan, the lender has a bigger claim, right? Because the claim against the borrower for the shortfall between the amount of mortgage balance and the proceeds received from the sale of property. So under the recourse loan, the lender has more security or less security? Yes. The lender has more security, right? Why? Because even if there is a shortfall from the asset, the lender can recover more money from you. But under the non-recourse loan, the lender can only look at the property, whatever she gets or he gets from the property. That's the only thing that the lender can claim, the bank can claim. Otherwise, they cannot claim anything extra. Are you getting my point? What do you think most of the home loans are? Are they recourse or non-recourse? Come on,
Recourse.
apply mind, everyone.
Recourse.
So are you telling me that, let's say you've taken a home loan and if you're not able to pay, the banks will take your property,
Sorry,
in
non-recourse.
personal account, or do both?
Non-recourse.
No, first answer me. Will the bank take only your property? Because see, you know what? You have to think finance from a real life angle. Otherwise, everything will be a burden. So what do you see around you when you are not able to pay the loans? Will the bank take your property and also freeze your personal accounts or your other? No,
take your property.
the banks have only claim to the property. So most of the residential mortgages are non-recourse.
Non-recourse.
Now tell me, if the value of your property is now $40 and the loan outstanding on your head is $100, what is the maximum that the bank can do? Take your property of $40, right?
Yes.
So if the value goes too much below the market value, too much below the loan value, sorry, the outstanding loan. If the market value of the house falls below the amount to be repaid under a non-recourse loan, then the borrower is tempted to deliberately default. This is called strategic default. Are you getting it? Why? Because even if I default, I'll lose only a $40 property and I'll get rid of the $100 loan. Clear? Yes or no? Yes or
Yes.
no? So strategic default happens when the value of your asset is below the outstanding.
Below the outstanding.
This is the problem in recourse or a non-recourse loan? In a non-recourse loan. This is a typical residential mortgage loan. How a home loan basically works. Now, when we have a pool of these various home loans that the housing finance companies are now going to sell it to the investors, those securities are called residential mortgage backed securities, RMBS. Is that clear, everyone? They are called as RMBS. Everyone clear what is RMBS? The underlying is a residential mortgage. Now, in US and in most of the part of the world, what should be the criteria for home loan is decided by some housing authority of the country or by the banks or the regulators, correct? Now, if a loan is approved where the borrower fits all the criteria. Then the central authorities, like the ones we have in US, the federal authorities, they do take the guarantees of those loans. They do take the guarantees of those loans. Who takes the guarantees? Some federal agencies. They provide a backup or guarantees of home loans. Won't that be very relieving for the investors that my borrowings, my underlying pool is being backed by some government agencies? Correct? Such types of securities are called agency RMBS. What is agency RMBS? Agency RMBS are the one which are backed or guaranteed by the US government or any central agencies. But non-agency RMBS are the ones which are not guaranteed by any central government or federal government or government sponsored entities. Is that clear, everyone? Two types of residential mortgages you have. Ones which are
backed by central
government or any government sponsored entities, or second, which are not backed.
Not.
The ones which are backed are called agency RMBS. The ones which are not backed are called non-agency RMBS. Which ones will be more riskier?
Non-agency.
Correct. So remember, non-agency RMBS have to give you more reliability. Therefore, they also have to do credit enhancement. Remember this.
Yes.
Okay. Now, how does a mortgage-backed security work? I've actually put up a picture from a news article, and I will come to this picture, but after we discuss everything. So what is RMBS? These are bonds created where the underlying is a mortgage loan. Now, in US, we have residential mortgages, which are divided into two types. As I said, agencies and non-agencies. Agencies, within the agencies, there are two categories. The ones which are guaranteed by federal agency and the one which are guaranteed by government sponsored entities. Both are different, right? So the federal agency is GNME, which is Government National Mortgage Association. So they are backed by the full faith of US government. But the ones which are guaranteed by government sponsored entities, so the government is not backing up completely, but yes, these are entities which are also part of government, like Fannie Mae and Freddie Mac, which is Federal National Mortgage Association and Home Loan Mortgage Association. So these are government sponsored entities, but they do not carry the full faith of the government, but they are virtually said to be risk-free. Clear? Either the government have sponsored them or some private entities like a bank have sponsored them, but they are not guaranteed as much as the ones which are guaranteed by the federal agencies. Still, someone is backing them, right? Therefore, they are called agency RMBS. Now, which types of loans will be the part of agency RMBS? All those which meet the standards set up by some regulators. For example, in India or in any part of the world, to get a home loan, you need to have some minimum credit score. Correct?
Yes.
So let's just shortlist a criteria that minimum credit score, all those who meet that minimum credit score, they all will get loans which are called confirming mortgage, which means they will get the mortgage, and those will be backed by the agencies because they are more safe. But that does not mean someone who has a bad credit rating does not ever get a loan. They get a loan, but at a high interest rates because there's a high risk involved. And these loans are not backed by any agencies. They are called non-agency RMBS. Is that clear? Everyone? Clear? Yes or no?
Yes.
Now, this since if you are going to be a buyer of the non-agency RMBS, mortgage-backed securities, then you're very much worried. So then there has to be a credit enhancement done by the SPV or the investment bankers before which you buy the securities. Clear? Everyone? I've attached the link for what is GNME, Fannie Mae and Freddie Mac in detail if you just want to go through. So what is the structure of a mortgage-backed security? See this. Can someone explain me through this diagram what they understand? Yes, very interesting. Everyone, what? This is Mr. John who buys the property. from the bank. Bank pools many of the loans like John's and makes a portfolio, then sells it to a larger bank like an investment banker, right? Who then creates various structures of these properties and sells it to various investors, isn't it? That's a typical mortgage-backed security, isn't it, everyone?
Yes.
Clear? Now, in this mortgage-backed securities, the securities which are sold to the investor, the securities which are sold to the investors, they are called mortgage pass-through securities. Why are they called pass-through securities? Because the pool, whatever money that is being generated from the pool in the form of interest, principal, or prepayment, that is simply passed to the investor directly. That is simply passed to the investor directly. That's why it's called a pass-through security, where money received from the borrowers, the obligors, will be passed to the investors easily. Clear?
Yes.
So agency RMBS are mortgage pass-through securities. Each mortgage pass-through securities represents a claim on the cash flows from the pool. And the pool can have several thousands or few of the mortgages, right? So when the mortgage is added in the pool, which now becomes a collateral, because why collateral? Because if something happens, I can rely on that asset for me to get my cash flows. This is the reason they are called now being securitized. So when the loan is put as a collateral and sold it to investors, we call it is securitized. So let's say a homeowner, I buy a home, correct? By taking funding from the bank. Am I clear? Now the banks will do what? The banks will, these are agency loans, so the banks will get it guaranteed, credit guaranteed by the rating, by the agencies, the government or the federal agencies, right? Fannie Mae, Freddie Mac, and Ginnie Mae, they will give me assurance. Of course, they will charge me some fee. They won't do it for free, right? Once they give it the assurance, then I can sell it to the investors. Is that clear? So whatever is the money that I pay as a home loan borrower, I will pay interest, principal, and repayment, principal repayment or prepayment, correct? That money will go to eventually to the investors, but after paying the fees to the servicer, right? The servicer who's going to help me structure all these things, they will charge some fees, right? So after deducting that fees, the money goes to the investors. It's passed to the investors. That's why it's called pass-through security. Everyone with me?
Yes.
So see this. What is the cash flow? Cash flow, which means what is the homeowner going to pay? Monthly mortgage payments of interest, scheduled principal repayment, and prepayments, if any. Correct? Will this entire money go to the investor?
No.
Some money will be deducted, which is called the service fee, which is typically some portion of the mortgage rate. So the monthly cash flow, whatever is the monthly cash flow, less some amount which is as a fee, will then go to the investors. Clear? Now the investors have actually invested in a bond, right? So they receive coupons. That coupon that they receive is actually a combination of various coupons of the pool. See, in the pool, there will be thousands of home loans. Will all the home loans be given at the same rate?
No.
No. So let's say there are 5 loans. For simplicity, 5 loans. Everyone has got equal amount. So one is being given at 10%, another is given at 12, 6, 5, 4, whatever. What if I take a weighted average of all those coupons, and that weighted average of all those coupons will be the coupon rate for the mortgage-backed security? Is that clear?
Yes.
And same way, will all the loans be given for same maturity? No. So the weighted average maturity of the pool is called WAM, weighted average maturity. Clear? Here, the weights are dependent on the amount. What is the amount of that particular, particular category divided by the total amount outstanding. So weighted average coupon and maturity are found in the same way, where in the weighted average coupon here, you will take the weighted average mortgage rate of each mortgage divided by the total mortgage outstanding. That will give you a percentage. Weight of every bond multiplied with their coupon will give you a weighted average coupon. And when you multiply them with the maturity, you'll get a weighted average maturity of the pool. Clear? So as an investor, when I'm buying the bond, I want to know the weighted average coupon and weighted average maturity, because not all have the same coupon and maturity. Is that clear? Everyone? Yes. What is the biggest risk that I as an investor face in this? Apart from the default risk, we are not talking about the default risk. What is the biggest risk? What is the biggest uncertainty in this pool? The prepayment risk, isn't it? Prepayment risk means they
Paying
pay
before the maturity.
Now, if they pay before time, your investment period will contract or expand. Contract. That's called contraction risk. Contraction risk happens when the prepayments are faster than the expectations. This happens when the interest rates are low or interest rates are high. When would borrowers refinance? Low. So when the interest rates are low, when the rates decline, the borrowers will try to refinance at the lower rate. Remember from the callable bonds?
Yes.
That callable bonds are exercised when the rates are low. That time the risk that we face is called contraction risk. But if the interest rates are rising, the borrowers will delay their principal repayment or delay their prepayments. Then you face extension risk. Extension risk is basically you get money late than your expectations. Your maturity is going to be higher than your expectations. Is that clear?
Yes.
So prepayment risk has both risks. If paid faster than the expectations, then you face contraction risk. If paid late than the expectations, then you face extension risk. Is that clear? Now, what is the expectation? How can I say that normally there are some prepayments expected every time, right? But are they more than the normal or the average expectation or less than the average expectation? How do we identify that? For that, we have a prepayment measurement called SMM, single monthly mortality rate. It is the average prepayment for the month divided by the beginning mortgage balance minus the scheduled prepayment for the month. For example, let's say the mortgage balance was 1,000 and people who are going to repay in this particular period is, let's say, let's say the mortgage payment was outstanding was 1,100 and the scheduled repayment was 100. So can I say after the repayment, the amount was supposed to be 1,000? The beginning mortgage balance minus the scheduled repayment, correct? Everyone?
Yes.
Now, how much did we actually prepay? If we paid 200, then this ratio is 200 divided by 1,000, which is 20%. Okay. 200 that is a prepayment for the month divided by the beginning mortgage balance minus the scheduled repayment. Now the answer will be what? It will be 20%. Am I correct?
Yes.
Now I have actually taken too high. Let's say I will take only 20. So it will be 2% for a month. Correct? How much annualized? 2 into 12, 24%, right? That annualized version is called CPR, conditional prepayment rate. So SMM is a monthly rate, and when you annualize it, it becomes a CPR. So what is the CPR? 24% in this case, right? Now let's assume that this is the normal CPR. This is generally the trend. Now you will keep watching this CPR or this SMM trend. All of a sudden you see a rise in this trend, then you will conclude that the prepayments are happening faster. Are you getting my point? Clear? Now, I don't know what is the average or the normal CPR or SMM, right? So there is this US agency, which is called Public Sector Association. They come up with a benchmark. And what do? They make the indexation of this by keeping the average prepayment as 100. Give the base value as what? 100. So the expected prepayment is 100. Now, whenever the value goes above 100, it means people are paying faster than the expectations. And when the value goes below 100, then people are paying late than the expectations. Are you getting my point?
Yes.
So the PSA benchmark is basically a prepayment pattern or benchmark over the life of the mortgage pool. So if the PSA prepayment benchmark, which is expressed as a monthly series of CPRs, basically it is SMM, right? So let's say a pool of mortgage with CPR of 8%, which means on an average in 1 year, 8% of the payments will happen, right? Correct. It indicates that each period, 8% of the pool's outstanding principal will be paid off. Now, let's say I give that 8% as a value of 100. I give that 8% as a value of 100. So it's called a 100 PSA. Okay. If you expect the PSA to be higher, if your assumption of PSA is higher than 100 PSA, which means the payments are faster than expectation or less? Faster than the expectations, right? If the payments are faster than the expectation, which risk will you face? Contraction or extension?
Contraction.
Very good. But if the payments assumption is less than 100 PSA, we will consider that the payments will be relatively slower. And when there are slower prepayments, we can probably face extension risk. Is that clear?
Yes.
Right. So tell me one thing. When you borrow, let's say you borrow for 20 years. So all the maturities of the loans will be, let's say 20 years, average maturity of all the loans. But will all the loans mature on the 20th year itself?
No.
If there are prepayments, won't they mature before time?
Yes.
So what is the life of the loan or what is the life of the pool is different from what is the maturity of the pool. Are you getting my point?
Yes.
What is the weighted average life? It is likely period investors can expect to retain the MBS by the borrowers before it could get payoff. So how long will you be held in the mortgage security? That is called weighted average life. But this weighted average life is inversely related to the assumed prepayment rate. Why? Because if the prepayments are happening faster, the life of your loan, the life of your pool will be lower.
Lower.
So higher the PSA means lower will be the weighted average life, not maturity, life of the loan. Because if the PSA is higher, people are paying
Faster.
and then the life of your pool will be low.
Lower.
Contraction risk. So I've given you an example out there. At 100 PSA, what is the average life that you can expect from the loan? 12 years.
12 years.
Now, as the PSA is increasing, what is happening? The average life is getting lower and lower. And at the PSA of 600, the maturity of the loan has become hardly 3.5. I mean, not maturity, the life of the loan has become 3.5.
3.5.
So at the prepayment rate of 600 PSA, the average life of the mortgage pass-through security is only 3.5 years. Is that clear?
Yes.
So if next time you want to see how faster the prepayments are, you will watch the PSA index. If it is higher than 100, then the prepayments are faster. This generally happens when the interest rates are down. This is called a typical mortgage pass-through security. Why is it called pass-through? Because the amount is simply directly passed through to the investors. Okay. Right?
Yes.
But one thing was missing here. When the amount was passed, there were no tranches created in a typical mortgage pass-through security, right? Right. I did not create any tranche in the previous one. If you see here, it was simply passed from one to another, right? So now what if I create tranches? Then it becomes a CMO, collateralized mortgage obligation. The biggest difference between the typical mortgage pass-through security and a CMO is the creation of tranches. You see that? The pool is now separated into various boxes, tranching, and then sold to investors. So if there is no tranching, it is just a mortgage pass-through security. But if there is a tranching, it is a CMO. What is a CMO? Collateralized mortgage obligation. Here, the cash flows of mortgage securities are redistributed towards various tranches. Redistributed means who get paid first? Tranche A, tranche AAA, then AA, then A, then triple B. So they will go in a structure which is what we call as a waterfall structure. Clear, everyone? So here, what is the situation? In a mortgage pass-through security, the collateral was a mortgage. Here, it's not a mortgage. Here, the collateral is not a pool of mortgage loans, but the securities, mortgage pass-through securities. What does it mean? Are you trying to connect something? Here, the securities there were no securities because you had the claim directly on the loans. That is mortgage pass-through securities, right? But now in the collateralized mortgage obligation, I am basically going to have an access to the pool of securities, and these securities have the underlying of mortgages. Now, how does it make a difference? Well, it does make a difference that now I am not directly going to get the income from the security, but it will be separated into various tranches in form of different securities, and then it will come back to me. So what is the biggest threat that I had in the mortgage pass-through security apart from the credit risk?
Prepayment risk.
Right. So the credit risk and the prepayment risk are now not eliminated, but they are redistributed between different classes. That's why we call now creating various tranches. Is that clear, everyone?
Yes.
The first type is a sequential pay tranche. The name itself says you something. What is that? Tell me. What does the name tell you? That the amount will be paid in sequence. Clear? So the precise amount and principal repayment will, however, depend on the cash of the collateral. But the amount will be first paid to tranche A, then B, then C, and so on. A major problem that remains is the considerable variability of the average life. You know what? Average life is unpredictable because, as I said, the prepayment risk is not eliminated, but just redistributed. Clear? So whenever the borrower pays, who get paid first? The top tranche. And after the top tranche is paid fully of what that is due to them, then the lower tranches receive the remaining amount. Correctly? Right? So lower tranches receive payments subsequently and remain protected from contraction risk. Wow. So the top tranche gets protected from extension risk because they will get the money on time. But the lower tranche gets protected from the contraction risk, so they don't get the money paid earlier. So the risk is not eliminated, just redistributed. Is that clear? This is first structure, which is called a sequential pay structure. Am I clear, everyone? Yes. The another structure is very interesting. It's called a pack and support tranche. What is it called? Pack, which is planned amortization class, and a support tranche. Very interesting. Tell me one thing. By buying this CMO, are you eliminated with both the risk, and which are the both the risk?
Credit and prepayment.
So are you eliminated from both the risk, whichever security you buy? No.
No.
But you want to get eliminated, right?
Yes.
So that is called a planned amortization schedule or planned amortization class tranche. What happens when there is a contraction risk, which means the money is paid faster, right?
Yes.
What is your wish? You want the money to be paid faster or late?
Late.
Late. If the money is paid late, you are saved from which risk? Contraction risk, right? Now, what do you notice here in this diagram? I'll first focus on the diagram. When there is a 50 PSA means the payments are happening faster or late? The prepayments are happening faster or late?
Faster. 50 in 50.
100 PSA means they are paid on time. Anything less than 100 means they are paid late. Greater than 100 means they are paid faster. Looks like you have forgotten.
Yes, it is high. No, yeah, I got it. Yeah, I got it. I got it.
If the PSA is high, the average life should reduce, right?
Yes.
Now think of an investor, a selfish investor. When the PSA is low, you're getting the money late, right? Now, what if there are only two people in this structure, you and your colleague? What will you expect? You will expect the money to be received early because the 50 PSA means the prepayments are happening late. So you would want the money faster, right? Correct?
Yes.
So you will get the money faster and your average life will be low. So how will I get money faster? Because whatever is the money that is being delayed is taken from another tranche, which is called the support tranche. That's your friend. She will support you in case if you are receiving the money late. So she will receive late. So her average life will be higher when the PSA is below 100. Are you getting me? Clear?
Yes.
And when the PSO, they have a collar of 250. So when the PSO is about 250, which means the payments are very fast, you don't want the money to be faster. So whatever is the money that you are getting extra, you will push it on the support tranche. So their average life will be very low compared to yours. Are you getting this? Correct? Just check it out. Right?
Yes.
And between 100 and 250, your average life does not change. Whatever is the variation, whether higher or lower, that you spill it over on the support tranche. So the support tranche supports you when the payments are faster and also when the payments are slower. They take that additional burden. Is that clear? Correct?
Yes.
Now I want you to read what is a pack tranche and a support tranche, please. Yes.
Pack tranche, the greater predictability of the cash flows for pack tranche occurs because a principal repayment schedule must be satisfied.
So they have more reliability or predictability of cash flows because any uncertainty will be borne by the support tranche. So who has the priority on everything? The pack or the support?
Pack.
Pack bondholders have a priority over other tranches in the CMO structure in terms of receiving the payments. So they have a greater certainty of cash flows, right? Which is due to the support given by the support tranche, or also called as a companion tranche, because they absorb all the prepayment risks. So if the prepayments are faster, they will take it over. If the prepayments are slower, they will give away their share and compensate to the pack tranche. So support tranche absorbs prepayments in excess of scheduled prepayments to the pack. If the prepayments are faster and if they are slower, they will give away their component to the pack. They do not receive any principal until the packed tranches receive their scheduled principal repayment. So until the packs receive whatever is due to them, the support tranches don't get any money. Of course, they are exposed to high risk, right? Therefore, they are exposed to both the types of the prepayment risk, extension and contraction, and therefore they will get higher yield also. Nothing is free. Clear? So their coupon may be same, but their YTMs may be higher of the support tranche. Is that clear? So what are the two structures that we understood? Sequential pay, where the money flows in sequence. So the extension and the contraction risk are distributed between the top and the bottom tranche. But in the packed tranche and the support tranche, the money is, the variability is all on the support tranche, not on the packed tranche. Clear? Everyone? Yes or no?
Yes.
Any doubt? Now, suppose you have this underlying pool of loans, right? Now, suppose they are fixed rate loans. One of the pool is a fixed rate loan. But an investor comes to me asking that, Kunal, I want a floating rate loan. How do I do that? So let's say I have a fixed rate mortgage at 10%. I have a fixed rate mortgage at 10%, right? So I am going to get 10% from the pool. And now I create two different floating rate bonds or two different floating rate instruments. One is a floater and another is a reverse floater. Both at 10%. And this 10% what I receive was fixed, right? So what happens to the one who has bought a floater at 10%? Whenever the interest rate rise, she will make money. But whenever the interest rate falls, she will have to give me money, isn't it?
Give money. Yes.
Opposite will happen with the interest rate, reverse floater. Reverse floater will get the money when the interest rate goes down and will pay me when the interest rate goes up. Now assume you've created a 10% floater and reverse floater. So you get 10% coupon from the underlying pool, right? You pass it on to the investors. Now, wherever the interest rate goes, you just have to contribute 10%. The extra will be given from one to another, from the reverse to basic floater and from the floater to the reverse floater. Are you getting my point? So basically, we can create or construct a floater and an inverse floater combination from a fixed rate tranche from the CMO. The floating tranche pays the higher rate when the interest rate goes up, and the inverse floater will pay a lower rate when the interest rate goes up. So they offset each other. So basically, what will be my outflow? Only 10%. Clear? And whatever is the difference, which will be shared between both. I don't have to deal with anything. Thus, a fixed rate tranche can now be used to satisfy the claim of a floating rate tranche. That's why it's called a floating rate tranche. It is not created directly as a floating rate bond, but it is combined by a reverse and inverse float, by a floater and an inverse floater, which is created from a fixed rate bond. Is that clear, everyone?
Yes.
All of this, CMOs, mortgage pass-through securities, they are agency-backed securities. Why? Because they all meet the criteria of home loan. They all meet the criteria, some standards set by the agencies. Therefore, they are guaranteed by the federal agencies, correct? But those which are not guaranteed by the US government or any entity, government-sponsored entity, they are called non-agency RMBS. What will I have to do for non-agency RMBS so that people buy my product? I will have to do some additional credit enhancement, correct? Everyone?
Yes.
Who gets agency? Agency loans are basically those who have met all the standards. Basically, they are the prime borrowers. But in the non-agency RMBS, you will also have subprime borrowers. Subprime borrowers, the case in US where the loans are also given to substandard borrowers. Clear? When this happens, it gives rise to what? Default, isn't it?
Yes.
That's why the US 2007-8 financial crisis was called a subprime mortgage crisis. Do you remember something like this?
Yes.
It was called subprime mortgage crisis because the mortgages were given to subprime borrowers, and that resulted in a blast. Okay. Why? Because they were not guaranteed by the central agencies. Correct? Now, the one who invests in the securities, of course, they will get the money in the waterfall structure. So the first tranche will be paid, then the second and the third. There are rules for allocation of realized losses because there are heavy losses also. So who will bear the loss first? Even that rule is set. Are you getting me? So is the default possible in these cases of loans?
Yes.
Very much. Therefore, whenever you invest in a non-agency RMBS, you should also look at two more criteria. Is the default rate, the potential, the assumed default rate, and if the default happens, how much will you be able to recover? That is both things, default rate and the recovery rate. Both are to be taken into consideration when you are investing in a security which is a non-agency RMBS. Is that clear? Yes or no? Everyone?
Yes.
Any doubts? Any questions, anyone?
So after the subprime crisis, is anything changed in the system, like in the structure of non-agency?
I'll tell you one thing where the problem was. Once we finish the today's topic, I'll tell you what exactly went wrong. Okay. But for that, you will have to wait. Why did it all collapse? Was the process to be blamed? What exactly was to be blamed? Who were the people to be blamed? Where it all went wrong? Where it all went out of control? We'll discuss that at the end of the section today. Don't worry. Okay.
Okay.
But before that, let me explain you what are the different types of mortgages. Right now, we just discussed what residential mortgages, correct? And in that, we discussed the CMO or mortgage pass-through securities. But there are also commercial mortgages. Are commercial mortgages more riskier than residential? Yes or not?
Yes.
Commercial properties, yes, because they are also dependent on the economic activity. So CMBS are backed by the pool of commercial mortgage or income producing properties such as multi-family properties like apartment buildings, office buildings, industrial properties, warehouses, shopping centers, hotels, spas, or whatever, wherever you do business, healthcare and all, right? They have a credit risk, yes, because commercial mortgages are generally non-recourse loan, like residential commercial are also non-recourse. So the lender has only the claim on the asset. Are you getting it?
Yes.
What are the key indicators that the lender has to check before they give the commercial loan? They have to check the loan to value ratio, which should be as low as possible. Clear? The debt to service coverage ratio, very important. Why are you buying a commercial property? To stay or to do business?
Do business.
So when you invest in a commercial property, you do expect rent, but you also pay some expenses. That's why we calculate NOI. If you understand from the alternatives investment, where you calculate NOI, net operating income, which is like a operating income, rent minus the maintenance and taxes and other things that you have to pay on the property. So if your NOI is higher as compared to the interest that you have to pay, in the typical debt service coverage ratio, you use EBIT. Correct? In the numerator, EBIT, earnings before interest and tax divided by the interest and the principal, right? In the properties case, you will use NOI instead of EBIT. Clear? What do you want this debt service coverage ratio to be? Higher or lower when you give the property? If you are a credit analyst, would you want the debt service coverage?
Lower.
Higher. You want more and more ability of the borrower to repay. No. What is in the numerator? Income. In the denominator, what do you have to repay? You want more of the numerator or the denominator?
Numerator.
You want more and more net income, net operating income compared to the loan. So loan to value ratio should be, what will give you more security? Loan to value ratio should be
low.
Debt coverage ratio should be higher. NOI should be higher. Clear? So higher NOI or debt service coverage ratio and lower LTV ratio, the more likely it is that the borrower will be able to meet the debt service payments. Okay. That is the typical commercial mortgage-backed security. So here in a commercial mortgage-backed security, these are also important criteria that we should look when we are investing. Now, is the structure similar to the RMBS, residential mortgage back? Let's see that. A credit rating agency determines the level of credit enhancement necessary to achieve a desired credit rating. Interest on the principal outstanding is paid to all the tranches. The lowest priority CM-based tranche, the lowest, it's a sequential pay, right? So the lowest tranche will receive first or last?
Last.
So they take the maximum risk, correct? So they are the ones who are also called as first loss piece or residual tranche or equity tranche, because their risk is very much like an equity, correct? Yes or no? Now, the borrowers are also have the choice to repay faster, but the lenders want to avoid them from paying faster, isn't it? Therefore, they use some call protection measures. What are call protection measures? Call protection measures are where the lender will try to discourage you from paying faster. So with CMBS, investors have considerable call protection, unlike in RMBS. In residentials, governments don't do that, don't allow that, right? But in commercial, which trades in the market, they are more likely to have a structure where the repayment or the prepayment, the faster payment is stopped. Also, the CMBS trades more in the market than the corporate bond, so there is high liquidity. Now, this call protection can be at the structure level or at the loan level. Structure level means we can separate them on the basis of sequences, correct? So not everyone will be paid first. It will be paid on the basis of sequence, correct? And then there is loan level conditions that you put so that people don't pay you faster. What are those? First of all, prepayment lockouts. Prepayment lockouts are the duration during which you cannot prepay. Remember callable bonds, lockout period? The bond will not be called before that point, right? The same way you have prepayment lockouts. Then you have prepayment penalty points, which generally is the case for home loans also when you do in countries like ours, that whenever you plan to prepay, they will tell you, okay, what is your outstanding amount? On that 1% we will charge you. That is called prepayment penalties, 1% on the outstanding balance. Now, why are you doing prepayment, by the way? Why are you paying earlier?
Because the interest rates are down.
So for the remaining maturity, you are going to save some money, right?
Yes.
So what if that money is your penalty? That's called yield maintenance charge. It's a penalty that neutralizes your benefit of refinance. Are you getting my point? So then there's no point of paying up early. Clear? Right? Everyone?
Yes.
And there is deficence. Now, deficence is a situation, a strategy using the government securities such that the cash flow match the interest and principal repayment as per the term of the loan. Wow, this is interesting. Let me explain you this. Let's say you are going to get money from you are the investor in the commercial mortgage-backed security, okay? You are the investor in the commercial mortgage-backed securities and you are the borrowers. So the borrowers are expected to pay the principal and interest, which will be passed on to you. Am I correct? Right? Yes or no?
Yes.
If the borrowers pay faster, then this money directly does not go to the investor. That is being put in a treasury bond. That is being put in a treasury bond. And from the treasury bond, then the money is being received to you. So you will never feel like the prepayment is done. Even if the borrower has repaid, that is reinvested again in a bond. Clear? Are you getting my point? So as an investor, I will never have the prepayment issue, because whenever the prepayment happens, they are automatically reinvested somewhere. Clear? This is called a deficient strategy. So this is how the commercial mortgage-backed securities investors will not or will get protected from the prepayments. Clear, everyone? Anyone? Any questions? Yes, no? Now, there is also one more situation here, which is very, very risky situation. Now, listen to this carefully. There is a provision called balloon maturity provision. Now, tell me one thing. You have given loan to someone, and now the maturity comes. So you are actually going to collect that huge payment from the borrower, right? But the borrower tells you that, give me more credit, give me more time. I am not able to pay in the position, in the current situation, right? So what will the lender do? Will the lender extend or not extend the maturity, the time period?
Might extend.
Might extend, right? So if the borrower fails to make the balloon payment, the big payment on maturity, the borrower has defaulted. So the lender may actually extend the loan and tell that take your time and pay me after a while. So that phase is called workout period, that extra time that you receive. Clear? Also, the lender may modify the loan terms and conditions. They may lower down the interest rates, or they may increase the interest rates, right? Because now the risk is higher. So what they generally do is that they modify the original loan terms and charge a higher interest rate called the default interest rate during the workout period. So they will give you space, but they will charge you higher rates. What is the risk here? The risk is, what if they don't repay this loan also? Why? Because you had actually taken a loan for being unable to pay a loan, isn't it? You get my point? You are actually doing what? You are taking a loan to repay another loan. And what if you are not able to repay that? What if your business does not work? Then now the lender's risk has multiplied. The risk that the borrower will not be able to make the balloon payment because either the borrower cannot arrange the refinancing or cannot sell the property to generate sufficient funds. That risk is called balloon risk, because the risk has now become big. Because of the term of the loan is extended by the lender during the workout period, the balloon risk is also the type of extension risk. So you're getting the money delayed, and your money is also, the risk has also multiplied. Clear, everyone? So this is all a part of commercial mortgage-backed security. Everyone with me on this? So we discussed two types of mortgage-backed securities, residential and commercial. Clear, everyone? Both are called mortgage because here the underlying is a property. But when the property is not involved, something else is involved, it's called a non-mortgage-backed security. Under the non-mortgage-backed security, we are going to discuss the auto loans and the credit card receivables. Clear? Non-mortgage-backed securities are type of assets where the collateral is not a mortgage. The auto loans, lease receivables, credit card receivables, personal loan, commercial loan, there are various forms of educational loans. There are various forms of non-mortgage-backed securities. They can be amortizing or non-amortizing. Amortizing like a residential mortgage where the repayment is in the form of principal and interest. That's mostly the case with car loans or automobile loans, correct? Right?
Yes.
The cash flows for the amortizing loan include interest, scheduled principal repayments, and prepayments, if any. Under the non-amortizing, there is no schedule for paying down the principal, and the prepayment issue does not affect at all, right? Because you're probably paying only interest till the maturity. Especially in the case of credit card receivable. Credit card receivable is an example of a non-amortizing loan, because when I take a credit card and I have to repay it, it's not a loan that I have to pay in installments. Are you getting it? So that's a different structure altogether when you are taking a credit card. That's a non-amortizing. Amortizing is when the principal and the interest are paid in installments. Clear? We just discussed something about the lockout period. Can you tell me what is the lockout period?
The prepayment cannot be done till the lockout period.
Right. Now here there is a slight difference here. Under the non-mortgage backed securities, during the lockout period, let's say you are holding a credit card receivable security. Okay. So I am the credit card buyer. I've been using credit card. What if I decide to surrender my card, right? Then this money will be repaid to you. Whatever is the charges that I pay, all this money will be your income because you are the investor in the security, right? Correct.
Yes.
But the credit card maturity is relatively very low. It's not like a home loan, which has 20-30 years maturity, right? Therefore, under the credit card receivables, what happens that whenever the credit card payments are received, they are being used to generate more credit cards. They are not paid directly to the investors for a particular period of time, right? To understand this more clearly, let's read that. Just read what is the lockout period and try to understand it from the credit card point of view. It will be easy. Read that.
Also called as revolving period is the period during which the principal received is reinvested to acquire additional loans with the principal equal to the total principal received from the cash flow.
So let's say you get some cash flows, but you don't want to pass it to the investor because investor has said that keep it with you, create more loans. Why are you giving it back to me? Let's make more money. So all that money, let's say it's a 5-year security. So within the first 2 years, whatever is the repayment, all that repayment will be used to create more securities. They will not be passed back to the investors. Clear? So yes. When this lockout period overs, what happens? Read that.
When the lockout period is over, any principal that is repaid will not be used to reinvest in new loan, but instead distributed to the bond classes.
Correct. So after the lockout period, if there is any prepayment, then it will be passed back to the investors. Otherwise, you can reuse it to create more loans. Clear?
Yes.
Yes. Now there are two types of basically non-mortgage backed securities that we are going to here focus on. That is auto loans and credit card receivables. Auto loans basically are a portfolio of car loans, right? Everyone? Now tell me one interesting thing. The people who have taken car loan, they will continuously pay the monthly installments of principals, interest and prepayment, right? But the prepayment can be due to, in the home loan, the prepayment can be due to you got additional wealth. That's why you do the prepayment, right? Correct?
Yes.
Here in the auto loan, the prepayment can be due to various other reasons also. What if you sell your car? What if you sell your car? So you'll have to repay the full loan, right? Reposition and resale of vehicles, insurance proceeds, if your car has met up with some accident, right? Then your car is finished, right? You will get the insurance claim, and then that can also be the situation where you repay the car amount, correct? So here the prepayment is not only due to the money that you've received and you want to clear out your loan, but that can be due to various reasons with respect to the car or the vehicle. Are you getting my point? And of course, refinancing at lower rate is always there. But as I said, insurance, accident, the car being taken over or the car being theft out or whatever, There can be various reasons due to which you may have to pay earlier. That's a possibility. In the prepayment chances are higher in a car loan. Is that clear? Are you getting my point? Yes or no? So can I say the auto loans or the auto loan receivables are more riskier for an investor than the home loan, or less riskier? If you consider prepayment risk also.
More riskier.
More riskier, right? Therefore,
Yes.
they have to require some form of credit enhancement. Clear?
Yes.
Now, when you buy a credit card, what are the things that you pay from it? What do you pay on a credit card? If you use the credit, you may pay interest charges.
Interest. Yes.
You pay annual maintenance charges of the card.
Annual fees, yes.
Annual fees, and then there may be some penalties for using the card, basically credit or delaying the payments or whatsoever. So these are basically said to be the finance charges overall, right? So at the time of purchase, the credit card holder is agreeing to repay the amount borrowed plus any applicable finance charges. The amount that the card holder has agreed to pay to the issuer of the card, the credit card, is basically going to be the credit card receivable to the investors, isn't it? Credit card receivable are used as collateral for the issuance of credit receivable backed securities. So when you're investing in a credit receivable backed securities, you are basically getting exposed to people's usage of credit cards. Are you getting my point? Which is a pool of credit card receivables. The cash flow consists of what? Finance charges, fees, and principal repayments. Finance charges, basically the interest, the annual fees, and if these guys take the loan and if they pay the principal back. Interest is paid to the security holders periodically, maybe monthly, quarterly, or semi-annually, like any other situation. And that interest can be fixed or floating. Roughly, most of them are floaters. So this is that they are talking about the investor's point of view. Clear? Certain provisions require the credit card receivable backed securities early amortization or rapid amortization of the principal if the certain event occurs. So if there is chances of default, then you may probably want the credit card holder to pay it faster to settle down the accounts. And in that case, the credit card receivable the securities investors will get their money faster. So that's all in all about. The only difference between both is that in the auto loan, the underlying is the car, where the prepayment can not only be due to the money that the borrower has, but also due to various other reasons like accidents and insurance and so on. In the credit card, the pool that generates cash flow is finance charges, fees, and prepayment. That's what you need to understand. Clear, everyone?
Yes.
Now, what are the different things that you have basically now, different types of loans you have, right? And they all loans are clubbed together. Did you not see this, right? So what if I club all the different types of asset-backed securities? Can you tell me a recipe, a Western recipe that you make where actually, let's say you are basically, you do the cooking, right? I'm sure, right? And I'm sure you must be cooking well also because you come from Maharashtra. So what do you do with some of the vegetables which are left out? Do you throw them?
No.
Tell me an interesting recipe that you make from all the small vegetables which are left out. What do you do? Do you do anything with that?
Yeah, I use it like.
What do you use it to make something creative?
Yes.
What can you do? Tell me a recipe. My mom uses this word called best from the waste. So she makes a mixture of something like a new vegetable, or a soup, which I feel, wow, what a new dish. But it's actually all the left out stuff, which is crushed together in a new recipe so that you don't get the taste of something that you even don't like. So there are some vegetables which I don't like, and my mom knows that well. I won't individually consume that. But then when it is put that all together in a soup or a salad, I may not even think about it. I may not even remember that, oh, I did eat this. You're getting my point? Correct? Yes or no?
Yes.
That is what is called as a CDO. Collateralized debt obligation. Collateralized debt obligation is a bond portfolio of various securities, which can be anything and everything. They are diversified pool. They can be CBOs. What is CBO, CLO? Can you read all this, please? What is a CBO?
Backed by corporate and emerging market bonds.
Bonds. So these are bonds. Okay. It can be CLO. Bank loans. It
Backed
can
by
be structured finance CDO, which is backed by various other securities like asset-backed securities, residential, commercial mortgage-backed securities, and even other CDOs. And when these CDOs are added with the credit default swaps, they become a synthetic CDO. So what is CDO? CDO basically, it's a mix of various left out vegetables in a soup, which can also add, you can also add another soup into it. It's a mix of everything. Are you getting my point? We in India call such things as bhel puri, if you remember. Everything that is left out, you club it and you make up a new dish. Are you getting my point? So that's a CDO. Correct? So what are you getting? You're getting a pool of assets which is so diversified that you actually don't know what the pool is about. Got it? Clear? Yes or no?
Yes.
So now listen this. Let's say I am a CDO manager. Can you see this diagram? Okay. I am a CDO manager. What is my job? Let's say I will put my $20. I will put my $20. I am like a, there are two partners like general partner and limited partner. I am a general partner. I put $20, correct? And another $80 I raise from investors, which are limited partners. Together we have $100. With this $100, I will create a portfolio or a pool of various assets, which can be securitized papers, which can be bonds, which can be loan obligations, which can be credit card receivable, which can be auto loan, which can be commercial mortgage, or which can also be another CDOs issued by someone else. I'll just mix up everything and create a portfolio. That portfolio will, let's say, give me some returns. Let's say this gives me an average return of 7%. Correct? Of this, I will then create various tranches or various credit tranching or time tranching, and then I'll sell it to the investors. So I can probably sell it to the investors, this 100 million portfolio at let's say 6%. So basically I'll make 1% gain on this. Clear? Correct? Now, ideally, we all are betting on, speculating on someone back who is going to pay the home loan. If they default, then the securitization chain will default. If the securitized papers default, then the CDOs will default. If the CDOs default, then this entire system will default, right? Are you getting yes or no? Hello?
Yes.
Right? So the situation here is that now the end users don't even know what is there in the CDO pool because it's a mixture of so many things. Now, how will I get inflow from the CDO as a CDO manager? Let's say you are the manager. How will you get inflow? The primary inflow is the interest which is going to be received from this pool, right? And here I will also take some leverage. I will also take some leverage. Why? Let me show you. So the structure of CDO is that the funds to purchase the collateral of assets of CDOs are obtained from the issuance of debt obligations. So I will borrow money from others, here $80, and then I will buy the CDO. I create the CDO. This debt obligations are bond classes or tranches. The bond classes include senior, mezzanine, and subordinate. Senior and mezzanine are top level. They will have a better credit rating, and then subordinate tranche will have the least credit rating. The one who's going to create this is called the CDO manager. Are you getting it? The CDO manager is also called the collateral manager. They seek to earn a rate of return higher than the aggregate cost of bonds. Means the cost of bond basically is 6%, and I will create a CDO which gives me more than 6. Clear? CDO is a leverage transaction, which means they also add derivatives used to it. Clear? So they also borrow the funds to create a bigger pool and then they invest. Isn't that riskier? You're betting on someone paying, and for that you also borrow the money, right? Basically, you have got nothing to do with the guy who's going to pay to the bank. You're betting whether he will pay or she will pay to the bank or not. And you're also betting on those who are betting on them. So basically, it's unnecessary speculation. So the actual loan may be 1 million, but so many people are betting on it that the market has become 100 million. Clear? For example, let's say I'm going to give exam, CFA exam. Okay. Now you all decide that let's bet Kunal sir will pass or not pass. So you all have started a bet of 100:1 or 10:1, some bet, right? Now someone who's seeing you wants to bet on you all that whether Deepthi will win, Divesh will win, Jay will win or not. So they are betting on you. And then the chain happens. Everyone is betting on each other. Clear? So my exam giving, which was let's say a $1 value, but since so many people are betting, it has quadrupled or multiplied into thousands of times, which is all artificial, hoax, isn't it? Getting my point? Clear? So the CDO structure, further I'll discuss what is the CDO structure. It imposes restriction on the CDO manager through various test limits, like the hedge fund managers have various restrictions before they can pull out the money. If the CDO manager fails certain tests, the payoff of the principal to the senior bond is required until the tests are satisfied. So the first payment will go to the senior bond. The CDO manager will not get paid. The ability of the CDO manager to make the interest payments on the bonds and payoffs of the bond classes as they mature depends on the performance of the collateral. It all depends on how the collateral is. What is the quality of the collateral? If the collateral defaults, the manager may not be in the position to pay the adequate returns promised to the investors. Clear? Even at the top tranches. Am I correct? So what is the CDO manager going to get? Interest from the collateral. And if they've used any derivatives, right, like credit default swaps, so if they've sold some protection, they may also get premium. If they've sold some option, they will also get some premium. Clear? So there are various ways through which you can make money from the pool. And of this money, you are going to pay to the CDO investors. So that includes interest payment to the various tranches, and which could be a fixed or a floating rate payment. And whatever is the remaining amount is being kept by who? By the government. No. Who's going to keep the remaining amount? The CDO manager. Clear? Now, everyone cleared with the structure? Now, let me tell you before we proceed ahead. By the way, we are done with the entire securitization process. But before we go ahead, let me now tell you where exactly and what problem happened in 2007-8. So this is the value chain or the chain of the securitization. Where do you think is the biggest problem here? Like where can the problem start?
default from paying the mortgages.
So the borrowers, the obligors, if they default, right?
Obligers, yes.
Now, when will they default? If they do not have the capacity to pay, right? Or if the LTV ratios have become so high that they feel that they should do a strategic default, isn't it?
Yes.
Because the property values are very low. So
Very low.
what happened, I'll tell you. In 2007-8, the investment bankers here were making substantial fees, from Lehman Brothers to Citibanks to Merrill Lynch to Morgan Stanley to Credit Suisse, UBS, Goldman Sachs. Everyone were making tremendous fees by selling these bonds to the big investors. So the IBs, investment bankers, were making good fee. And do you know the portfolio size was in billions of dollars? So they were making a very good fee on it. Clear? Now the investors here, mutual funds or banks or corporates or insurance companies, they wanted more and more such securities where they would get better returns, because for them to put the money in treasury bonds hardly fetch them anything. Are you getting my point?
Yes.
So there was a moral hazard. There was a moral hazard where the investors were inquiring to the investment bankers, do you have more securities? Do you have more securities? So there was huge demand created. What will the investment bankers do? Who will they contact to get more securities?
Banks.
The SPV and finally the bank, right?
Yeah.
So they will tell the bank that, banks, give me as many securities as possible. Now the bank will tell that, I have already given loan to a lot of people. So the investment bankers will tell, give more loans. And then the greed started coming. So the banks started now giving loan to the subprime borrowers also. Those who did not have the eligibility, they started getting loans. Those who already had the property, they got the loans for more and more property. So that created an artificial bubble in the real estate. Are you getting my point? And when the time came to repayment, many of these guys did not have the potential to pay back. So whenever the property prices crashed even by 10 to 20%, people started doing strategic default. Are you getting it? Now that strategic default, which was fueled by the crash in the real estate, who started getting default? The SPV did not have money. The investment bankers started giving away on these papers and pushing from one bank to another bank. And everyone who were finally holding the papers were defaulting. So Lehman Brothers had those securitized papers which were not even fetching them, I think $10, 10 cents for a dollar. They were getting less than that. No one was willing to buy the papers that investment banker like Lehman Brothers had. So they had to suffer huge losses, so much so that they had to go bankrupt overnight. Bear Stearns, Lehman Brothers. Why? Because now they were carrying papers which had already defaulted. But what were the credit rating agencies doing? Well, they were giving it AAA because they thought that, wow, these all mortgages are being evaluated well and given, and it's a pool of mortgages. So they had never imagined a scenario where everyone will default. They could never recognize that there was a property bubble going on. So just before the day of default also, they had been giving AAA rating. So the investors thought that, wow, it's AAA, it's very safe. But they didn't realize it's all a bundle. The bundle is a bubble here. So that's where the subprime borrowers started defaulting because of the real estate crash, which was fueled by the bubble, which was pushed by these investors and the investment bankers. Everyone made fat bonuses in the previous years, luxury cars and everything. And when the default started happening, they just ran off from the company, and the government had to bail out these banks because the losses were huge. And you cannot, under a non-recourse loan, the only thing you can do is take a property. So then most of these banks had to be bailed out because they were involved in this securitization. And then they had sold the default swap on this particular instruments also, because they thought that these instruments will never default. Correct? So let's say I come to you and I tell that, you know what, I think that these bonds will default. No one believed actually that this securitized paper, which are AAA, can ever default. So there was basically an investor, which is called the investor, basically this guy who basically realized that there is a bubble and there is a default which is going to increase. So he went to the office of Deutsche Bank, Citibank, and everyone and told them that I need to buy insurance on these bonds which are AAA. You know what happened? The bank started laughing at him. The bank said that who buys insurance on a AAA bond? He bought insurance. What was the insurance? Credit default swap. So he was paying premiums, but if the bonds default, the banks have to pay the
money,
right? Yes. Now imagine the banks were selling these bonds and selling the insurance of this bond. Clear? So if the bonds default, the banks will lose money on the bonds, and they will also have to pay the insurance for the one who buys insurance. Clear? So banks were facing double risk. And then the same banks or the same bank managers had created a CDO and sold it, which had so many various other bonds. So the banks had increased their position tremendously by creating multiple artificial assets of the same debt or the same bonds. So once this pool of assets started crumbling down, everything, the CDOs and perhaps all the securitized assets started defaulting. There were huge outflows that the banks had to do on the credit default swap. Clear? And those few guys who knew this, they made tremendous wealth by just, taking the positions right before the fall. Correct? Everyone? Now, all this is very well, all that I discussed is very well explained in these two links that I'm going to share you, or probably you can go to the YouTube channel also and watch the Big Short movie. In this movie, they have explained the character called Jared Vanet, which is Ryan Gosling. He has very well explained what is the subprime crisis and how, and it's a real life story, by the way. So he basically, I think his real life name is Greg or something like that. So he has explained that how is this going to crash, and very rare people believed. And then there is Mark Baum, another character of Steve Eisman, who was, I think, handling Forefront Capital, and he realized that how the CDO market is a hoax completely, and that's going to fall down. And in between that, what is a CDO? What is, how does this work and all? That all is very well explained by the world-renowned chef, Anthony Bourdain now, who is no more, unfortunately. Then Selena Gomez and various other characters are there who will explain this concept very beautifully. So I would want you all to, if you want to revise this topic, just watch these two clips, which I'm sharing the link here, and you will understand everything that I discussed in the last 2.5 hours. Okay, that's what this movie is. So I would recommend everyone to go ahead and watch this movie. You'll understand the entire subprime crisis in a matter of 10 to 15 minutes. And you can reconnect everything that I said in the class. Clear? Everyone?
Yes.
Correct. This is how the US bank collapsed because of the overambition. They also made a lot of money by the securitization, by the way, right? And they also lost a lot of money. So my view is that securitization is like, a tool or a weapon. Now you want to use it for defense or you want to use it for harassing someone. That's up to you. So the world is incomplete without the securitization. It has tremendously grown the business. For example, in India, we have companies like Bajaj Finance, right? Just see where the stock has gone. It has gone more than 2,000 times. That's because of the process of securitization, that they are able to generate more and more loans, and they are able to sell more and more loans. So securitization has helped credit run faster, helped diversify the risk, given investors the choice to select the securities that they want. But The process has to be clean and more transparent. Otherwise, you don't know who, what you are buying up. Is that clear, everyone?
Yes.
Any questions, anyone?
So the Fed rates, like when the subprime issue was going on, in at that point the Fed rates were like low because it was issuing more loan. Like,
see, one thing that happened that the Fed rates initially were not so low, but then when the bubble bursted, I remember very much, very well at that point of time, when the bubble started bursting, the government came up with bailout package. They bailed out, I think they initially started with a $600 billion bailout package. So when the government issues bonds in the market, definitely the interest rates rise. But the Fed wanted to spur the economy. So the Fed basically, they were working on a Keynesian theory. John Maynard Keynes, who was an economist, which we will study probably some glimpse of that in economics as well. John Maynard Keynes said that when the economy was in the Great Depression in 1929, he said that the governments need to intervene and boost the economy by giving credit. So the Fed actually started reducing the rates to the zero rates. That's where you saw interest rates zero for a very long period after 2007-8.
yes.
So that's where it's called a monetary policy. So they started reducing the rates to boost the economy, but they struggled a lot in that. They probably could not, they are so scared now to increase the rates, whether if I increase the rates, there should not be a recession. Every time they think of increasing the rates, something bad in the economy happens. That's the reason why even after 10, 12 years now, you see the interest rates are still around, hovering around 0 or 1 or 2% all over the world, except the emerging nations. In the developed nations, they have still not got over with the lower interest rates. So most of the global economy surge that you see is completely not realistic. It is also fueled by the monetary supply. Got it?
Yes.
Any doubt or anything? Please let me know. If not, that's it from my end. If there is any doubt, you can definitely come back to me. Do watch the links. I'll share the links. Do watch the link, or if you get a chance, do watch the movie. It's a beautiful movie. It's an amazing movie. You have Christian Bale, you have Brad Pitt in the movie, and you have Ryan Gosling and so many interesting characters. You'll really enjoy the movie. Every part of the movie is like related to what we've done. So when you do derivatives, when you do securitization, all this will be so interesting that you will be able to connect it, alternatives and all, in that one particular movie. Normally, I recommend everyone to watch this after derivatives, alternatives, and fixed income is done. So if you get time, do watch this. Okay. The movie's name is The Big Short. Clear? That's it from my end. If you have any doubt, let me know, or else we'll meet in the next section. Correct? Okay.
Okay. Yeah.
See you. Bye-bye.
Thank you.
Yeah. Bye.